Good morning, everybody, and welcome to the morning meeting of the ARMR Investing Virtual Hedge Fund. You're a portfolio manager on the desk. We're all in the meeting together getting ready for our trading session. We're going to go over risk monitor / market commentary. We're going to talk about the highlighted trade of the day yesterday. We're going to look at the top shelf stocks to watch that we'll be looking to buy perhaps today. And then some quick research notes, something that's very important for us to focus on because it has a lot of sway over equities. So as always, don't forget, you're the portfolio manager on the desk. I'm going to share information as the CIO. You figure out how it fits your risk tolerance, your goals, and then you execute from there. Quick programming note. Today, 11 years ago, no, 10 years ago, today, 10 years ago, this guy became a dad. Unbelievable. I can't believe my son's 10 years old. Wow, man. And the time is like flying. You know what I'm saying? Maybe we'll talk about that some other time. Let's hop into the stock market. Commentary around the market. Let's take a look real quick at this chart here of the S&P and the NASDAQ. There's a lot of noise right in here, but what I wanted to show you on the S&P and the NASDAQ is this. This is the week's worth of trading. So I'm just going to blow it up for you. And what you're going to see is a lot of resistance right at this key level here, this blue line right in here, and then it would be right in the same vein over here. So on the left is the S&P, on the right is the NASDAQ. Okay, the market keeps meeting resistance at the 450 level on the S&P and the 375 level on the NASDAQ. Okay, and this is what distribution looks like. So it's not a surprise what's happening this week. We're at the end of a little over a week of Risk Monitor Red. And during Risk Monitor Red, you're going to get rejections at key levels. You're getting distribution. So the market tries to recover and then institutions come in and sell. That's what a Risk Monitor Red looks like. So the key levels of 450 and 375, 450 S&P, 375 NASDAQ, that's like the line in the sand. If we can close above those levels, we might get close to a Risk Monitor green scenario again. That would be great. Markets are pulling right back to key levels. Some big stocks, we're going to look at stocks to watch in a minute, are sitting right around the 50-day moving average. And that's a healthy pullback that we look for in any uptrend. Market gets ahead of itself, then it retrenches, holds the 50, then it starts the next leg up. So we're looking at that, these levels, the 450, the 375. If we exceed them, then it would be a good test below, breakout above. But until then, we have to look at the reality of the situation. And this is Risk Monitor Red, risk off, be defensive. Market doesn't look good. It was a lousy week. And if we close on the lows and we take out these levels down here, right? If we take out those lows, which right around what, 445, let's say, on the S&P and 367 on NASDAQ, taking out the lows of the week. If we were to close below the lows of the week, that would suggest that the Risk Monitor Red signal from last week is accelerating. And so the order of the day is caution, is defense, is protection of capital, right? So if you look in our portfolios, what we're doing, I'm about 60% cash in the average portfolio I run. And in the aggressive portfolio I run, when I mean aggressive, I mean a trading portfolio that's willing to get in and get out fast. That portfolio probably has a lot more cash in it, okay? A lot more cash. So anywhere from 60% cash to a lot more cash is where the thought process would be if one is trying to align themselves with the risk monitor, okay? I know there's some talk about Well, if the U.S. is going to struggle, then why not move into things like emerging markets? Yeah, they don't look too bad, right? China's here, although it's going to drop 2%. So this is not showing China's down 2% right now. So, and I mentioned this about China because the charts look okay, right? Here's EEM, emerging markets. So emerging markets are trying to hold up in here. But I will remind you that if the U.S. ship sinks, everything goes down with it. That's just the way the market is, until further notice. If you want to make a bet that this time will be different, that's your prerogative. But I don't work like that. I work on probability statistics. And from a statistical point of view, if U.S. equity markets are breaking down and U.S. bond markets are breaking down, so interest rates are going up around the world, okay, all the assets go down. That's just the way it is. Don't hate the player, hate the game if you want, but that's just the way it is. So there's no way I would shift out of the U.S. and start buying assets in other markets. I don't care how good they look right now. If the U.S. breaks down, it's going to suck everything down into that into that whirlpool. Quick note that we get from IBD this morning, just to go over what's happened in China overnight. Chinese stock market fell a couple percent. Hang Seng down 1%, Shanghai down 2%. And the reason is the largest surviving Chinese property developer, which has massive first half losses, has missed an interest payment. We've been here before. They start missing interest payments, it destabilizes emerging markets everywhere. So that's not a place to hide. Cash is a place to be, particularly in the U.S., where U.S. Treasury bills are giving us 5+% rates of return. I'm getting 5.5% in a bill that expires at the end of this year. I mean, that's like found money, guys. At some point, that sucking sound you hear out of equities is hiding. What did I see? I don't want to say something that's incorrect, but there's some ridiculously high rates over the 5 to 7 year paper right now. When I say ridiculously high, in relative terms to what we've seen over the last decade, and it's like sucking money over there. Just put the capital there and it's safe money, theoretically, right? So that is the backdrop of what the market's fighting against. And I may as well share with you then the chart pattern that I find most disturbing that we have to keep our eye on. This is the highlighted chart of the day, the research part, okay? Right in here, this is Treasuries, TLT, okay? This is long-dated U.S. Treasury bonds, okay? Right here, this breakdown yesterday, all those green dots are volume selling. So no volume all day. Then you see volume come in and hammer Treasuries. This was another auction. So, typically there'll be auction news and it doesn't really mean much. The bonds will be down for 3 to 6 minutes and then reverse back up and nobody cares. People really cared yesterday. That auction news hit the tape at 1 o'clock and massive volume hit long dated Treasury bonds. That's not a good sign. And then you shift over to the daily chart and you could see we're challenging last year's lows, which means last year's highs in interest rates. The last thing you want to see is for U.S. Treasury bonds to take out the lows of last year, which would suggest a new downtrend beginning in long-dated bonds, which would be a rally in yields, which would suck more capital out of equities. So risk monitors red. It's not the end of the world yet, but this is something to keep your eye on, because if this gets worse, it's going to be very hard for the risk monitor to go back to green, is my guess. Okay. Now, having said all that, how are we making money in this market? Well, we totally, absolutely crushed it yesterday following the day trading playbook, the ARMR day trading playbook. Okay. And I'm going to just show you the play from yesterday. And actually, I'll show you the play from the last 2 days. Okay. This is how we make money trading in every market, but particularly in a risk monitor red market, we're carrying tons of cash. So we're being very defensive. We sleep on cash. Then we harvest alpha using the playbook and go back to cash and avoid the collapse. I do this with a third or more of my personal capital that I'm running. So at this virtual hedge fund, part of my desk is just day trading. And all I do is focus on trading the S&P. And then what I do is focus on trading triple the S&P, right? So it's a very conservative strategy. It sits in cash. I have no overnight risk. So when the window opens to put capital to work and harvest alpha, I'm putting 100% of the portfolio to work, capturing 300% upside in the S&P. So theoretically, the whole portfolio gets put to work. The S&P goes up 1%. The portfolio is up 3%. In theory, right? That would be a huge day. That's what we're trying to do. Okay? So 2 days ago, we captured this trade. The market opened flat. And the day trading playbook, think about that playbook that I share with you as like a football coach on the sidelines, right? And he's got his ringed binder with all the plays in there, right? And they're flipping through plays. Maybe they use a Microsoft Surface now instead of a ring binder, but you get it, all right? I'm an old school guy. I like the ring binder. I like the tabs that show me different types of plays, okay? So we've broken down the playbook into 3 tabs: gap up, gap down, flat. The market opens flat, there's only so many ways it can trade that would reveal an opportunity for us, okay? And so typically it's going to be after a sell-off. The flat open that sells off, then we look for the rally. And so we captured this entire move. These red lines are where the stops go. We keep raising stops all the way until the last stop gets hit, and we're out of the whole trade right at the highs of the day. We pick off the trade here. There are 5, count them, 5 day trading playbook buy triggers. There's a lock and loaded bar and then the buy trigger. This is an easy strategy to follow. You guys can write these down on your own. I'm happy to share these 5 triggers. The one you're looking at right here, there's 2 different ones I'm sharing with you here of the 5. This right here on Wednesday was what I call the buy trigger, which is the move back above the first standard deviation below the VWAP. So once again, you're looking at a chart of all of the price movement profile. It's a 3-minute chart. Every bar is 3 minutes. Ups, blue, reds, magenta's down. All the lines are drawn for us by the algo. Black dots are the VWAP. A lot of what we do is mean reversion trade. So when we're below the VWAP, and these are the 3 standard deviations below the VWAP, and the first standard deviation is far enough away from the VWAP, we get a mean reversion trade where we're looking for a trade from 1 standard deviation below the VWAP to 1 standard deviation above the VWAP. That's the mean reversion, okay? And so it happens right here. The trigger bar is, the locked and loaded bar is white. The trigger bar takes out the high of the L and L bar. That's where we get long. Then we just start following up. We always book some at the VWAP just in case the mean reversion's just to the mean, which would be the VWAP, volume weighted average price. That's the mean. But very often it overshoots to the first standard deviation above, which it did. We booked some profits there. Then it got ahead of itself and we booked the rest of our profits. Yesterday, we made the only money there was to make in the morning before the market imploded. And yesterday's trade is what we call a gap and go. So if we can make money on a gap and go trade, think about it. If we can make money on a gap and go trade yesterday, a day where the market imploded, that gap and go signal is money because it'll make a lot of money on a good day where it gaps and goes and never comes back. It just goes berserk. Those are the days you can really bank out. Sometimes a gap and go day, the market could end up 2% on the day. And so that's the day where a day trading portfolio, 300% exposure, you might be able to see a day where you're up 2%. Now, you're probably not going to capture the whole 3% move, but you could, right? So if we could make money on a gap and go yesterday, we can make money on a gap and go any day. What's the gap and go scenario? This is right out of the playbook. And this is literally a play from the playbook. Here's the gap. Market closed here, opens here. It's a gap. Okay. You wait for the first 15 minutes. That's the opening range. And when you take out the high of the first 15 minutes, that's the go. So I would almost say the locked and loaded bar is really the first 15 minutes. So there's the locked and loaded setup. So now you're ready to fire. And when it takes out the high, you get long right here. You don't wait for the end of the bar. The minute it takes out the high, you're long. And the stop is the low of the bar going through the opening range high. It rips higher. We book some of our gains at the ATR high of the day. We book more of our gains at the ARMR moving average, which tends to be resistance. And it was the top of the day. We were out of half of our trade right here and the other half right there as the stop that was raised was taken out. And I want to just share this thought with you. This stop strategy is so important and can be executed with any stop strategy when you're day trading anything. If you're on an impulse move higher, which is what day trading is, and this stop strategy gets stopped out, that impulse is over. Now, there could be another trade later in the day, but that trade's done. And you got to book your profit and stop trading the asset until a whole new strategy sets up from your playbook or mine, right? It's information the market's telling you when that stop is finally hit. It tells you the impulse is over. And in this particular case, the market imploded afterwards, okay? So we avoid trading the rest of the day. And we avoided trading because we have a strategy called an indicator called the ATR, average true range high and low indicator. When the average true range high starts to stair step down like it does in here, these red arrows, it tells us we're done trading on the long side for the day. That's it. There's no rip higher going to happen. There'll be little jumps higher, but nothing that makes the reward risk matrix worth it. How many of you have a great trade in the morning and then piss it away the rest of the day trying everything else? I know you're out there because I used to do it. Have a great morning. Feel like King Kong. Start throwing money around in the afternoon. Maybe this will work. Maybe that'll work. And all you do is give away your gains. High grade your trading. Only trade your best setups. Be content with the money you make. Wait for the next day. Wait for the next setup. That's my thought for you. And I'll wrap up with what's at the top of our whiteboard. So I've given you all the downside. I've given you all the nasty. But then again, there are always some rays of light. Okay. Monster is locked and loaded. I'm looking to get on Monster. And it tends to follow. They kind of run together. Celsius, which just blew out on earnings. We listened to the conference call. A monster. It's just a monster. It's a great idea. It's locked and loaded. That's what the white bar is. If we close above the high of that white bar in the green zone, I'll probably be long Monster, even though the risk monitor is red. Every now and then I'll take a shot on a perfect setup like that. Also, there are a number of key big cap tech stocks that are at major support levels now. Let's take a look. Okay. All is not lost unless the 50-day moving average breaks. If Nvidia holds that black line, that's one step away from a buy signal reversal off of the 50 that I will be all over. Okay. So you got Nvidia, you got Tesla, right at the 50, right at the support line. You have ServiceNow right on the 50. I'd love to get long ServiceNow. All right. So just to temper our negative, a loop, there are a number of ideas. I think Lululemon looks great. Okay. That's trying to make the move coming off of that tight base. So there's always stocks at the top of our whiteboard. All right. I want to really own Marvell. There it is breaking below the 50, but a break below that reverses back up will be a buy trigger. Okay. And I think the highlighted group of the day has to be semiconductors. They're right on the 50. They're right on a support. You could bring it down into here. It's challenging the uptrend. If it reverses back above Let me tell you something right now, ladies and gentlemen. If that reverses back above, I will be on Nvidia, MRVL, and the semiconductor index. It'll be a perfect test of the 50. So all is not lost yet. Keep your eye on treasuries. We'll see if the market can get rescued on a Friday afternoon. Right now, the market looks to open flat. This will be a flat open. So I go to my playbook, open it up to the flat opens, look to see what the trade's going to be this morning. Don't know what it is, but I'll share it with you when I find it. And I'll see you at 9:30 on the live desk. You all have a great trading session.